Since 1928, the US stock market has been in a bull market approximately 78% of the time. History is clearly on the side of the optimist, yet a study by Putnam Investments revealed that over the 20 years from 2003 to 2023, if an investor missed just the 10 best days in the market, their total return was cut in half. Missing the 30 best days resulted in a negative return. The lesson is profound. Bull markets build wealth slowly, while bear markets offer the moments of extreme volatility where fortunes are either made or lost. In the next 10 minutes, you'll learn the precise definitions of bull and bear markets, understand the economic and psychological forces that drive them, and discover a strategic framework for not just surviving bear markets, but actively harnessing their power to accelerate your long-term wealth. The foundation. The two faces of the market. At its core, the market has two primary states, two distinct personalities, the bull and the bear. A bull market is a period of sustained and substantial price increases in a market or index. The technical definition is a 20% rise from a recent low without an intervening 20% decline. It's characterized by widespread optimism, investor confidence, and positive economic sentiment. The name comes from the way a bull attacks, thrusting its horns up into the air. A bear market is the opposite. It's a period of prolonged and significant price declines. The technical definition is a 20% or greater decline from a recent high. It's characterized by pessimism, fear, and a deteriorating economic outlook. The name is thought to come from the way a bear attacks, swiping its powerful paws downward. Crucially, these are not just abstract market phenomena. They are reflections of the broader economic cycle. Bull markets almost always coincide with periods of economic expansion, low unemployment, strong GDP growth, and rising corporate profits. Bear markets are the companions of economic contraction and recession. They are the two faces of the same economic coin. So we have the optimist and the pessimist, the bull and the bear. But these are not just labels. They are distinct economic environments with their own playbooks. What are the key characteristics of each? And how can you tell which animal is in control of the market right now? The core mechanics. Identifying the environment. To navigate the market, you must first be able to read the weather. Each market environment has a distinct and recognizable set of characteristics. Theory. The market playbook. In a bull market, investor confidence is high. There is a strong demand for stocks, leading to a risk-on environment. Economic news is generally positive, unemployment is falling, and corporate earnings are strong. Money is easy, meaning access to loans is good, and mortgage rates are often stable or falling, which fuels further economic activity. In a bear market, investor confidence is low. There is a flight to safety, where investors sell risky assets like stocks and flee to the perceived safety of government bonds and cash. Economic news is negative, unemployment is rising, and a recession is either underway or expected. Money becomes tight as lenders become more cautious. Analogy: the river kayaker. Think of your investing journey as paddling a kayak down a long river. A bull market is like paddling downstream with a strong, steady current at your back. The force of economic growth and positive sentiment propels you forward. You still have to paddle correctly, that is, invest in good companies. But progress feels easy, almost inevitable. Even a novice kayaker can make good time. A bear market is like trying to paddle that same kayak upstream against a raging current. The powerful forces of economic contraction and fear are actively working against you. It takes immense skill, strength, and discipline just to keep from losing ground. Novice kayakers are quickly overwhelmed, capsized, and swept away by the current, losing their capital. Example: the investor's action plan. The correct strategy is entirely dependent on the prevailing current. Bull market strategy. Your primary job is to stay in the kayak and keep paddling. The biggest mistake is to get scared by minor rapids, market corrections, and jump out of the boat, missing the long, powerful ride downstream. This is the phase where you let the compounding in your investment portfolio do the heavy lifting. Bear market strategy. This is where true fortunes are made. The amateur panics and sells everything, locking in devastating losses. The professional, who has been preparing for this moment, sees a once-in-a-decade sale. This is the time to deploy the cash you've set aside and buy high-quality assets at deeply discounted prices. A sound wealth management plan, often crafted with a financial advisor, includes having a bear market shopping list ready to go. Common pitfalls and the advanced strategy. The transition between these two states is where the most money is lost, due to two critical errors. Pitfalls to avoid. The extrapolation trap. This is the belief that the current trend will continue indefinitely. At the peak of a bull market, investors' brains become wired to expect rising prices, and they forget that bear markets are a natural and inevitable part of the cycle. At the bottom of a bear market, investors are so traumatized that they believe the world is ending and prices will never recover. Both are fatal errors of imagination. Confusing a correction with a bear. A correction is a short-term drop of 19.9% from a market high. Corrections are common, happening on average about once every 2 years. They are healthy, as they shake out speculation. A bear market is a deeper, more prolonged, and fundamentally driven decline of 20% or more. Knowing the difference can prevent you from panic selling during a routine and temporary dip. The advanced strategy, the rebalancing bonus. Avoiding these traps is what separates amateurs from professionals. But beyond simply having cash to buy the dip, the truly advanced strategy is to use a bear market to systematically rebalance your portfolio. How it works. Let's say your target asset allocation is a classic 60% in stocks and 40% in bonds. After a long bull market, your stocks may have grown to represent 70% of your portfolio, and your bonds only 30%. In a bear market, the opposite happens. A 30% drop in your stocks could leave your portfolio at 50% stocks and 50% bonds. The rebalancing trade. The disciplined rebalancing rule says that when your allocation drifts too far from its target, you must take action. In the bear market scenario, you would sell a portion of your now overweight, relatively safe bonds and use the proceeds to buy more of your now underweight, beaten-down stocks. Why it's brilliant. This is a simple, non-emotional, rules-based system that forces you to obey the cardinal rule of investing. Sell high and buy low. You are systematically selling the asset that has performed well and is now a larger part of your portfolio, and buying the asset that is on sale. When the bull market inevitably returns, this rebalancing bonus will act as a powerful accelerator on your portfolio's recovery and subsequent growth. The synthesis. 3 core truths. Let's distill this into the 3 essential principles for navigating the market's 2 faces. Markets are cyclical. A bull market is a prolonged period of rising prices, 20% or more, fueled by economic expansion and optimism. A bear market is a significant price decline, 20% or more, driven by economic contraction and fear. They are an inevitable, repeating pattern. Amateurs react. Professionals prepare. The amateur investor is a victim of these cycles, buying into the bull's euphoria and panic selling in the bear's despair. The professional investor uses these emotional swings as opportunities to buy low and sell high. Rebalance to capitalize. The advanced strategy is to use a bear market as an opportunity to systematically rebalance your portfolio. This forces you to sell what has held its value and buy what is on sale, supercharging your returns when the bull market returns. You cannot control the river's current, but by understanding it, you can position your boat to harness its power, turning the inevitable cycles of the market into the engine of your wealth. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.